trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again to all of our options traders and market rebels out there. And we are in South Florida in the middle of a torrential downpour, Stu. So I'm hoping that my internet holds out on this ugly day. And it looks like the SPY's down about, what, 0.75%? Looks like maybe?
Yeah, three quarters of 1%. Dow is down, looks like the Dow is down right around the same. So yeah, little less than 1% down.
Yeah, but we got that two candle break below the 100-day. I'm sorry, below the 50-day. I think we were talking about that. So we'll have to see how that shakes out later in the week. Mm-hmm. So anyway, today we got more good stuff for everybody out there, and just trying to get this Thinkorswim out of the way. There we go. And we wanted to bring a topic to you that we think is super important. They're all super important, really. Anything you learn in options trading can only help you, to make better decisions. But it's something that Stu and I stumble onto all the time. And it's like everybody gets it wrong. We thought, well, this might be a good topic for Coach's Corner. And so that's what we're going to do today. So to kick things off, let's go ahead and jump over to Chalk Talk. Now, for anybody who's new, Chalk Talk is our kind of a little, what would you call it, Stu? A brain teaser, trivia question type of thing.
Something to get you thinking outside the box.
Something to get you thinking outside the box. And we just ask you to maybe just take a quick thought, jot something down. We like you to commit to an answer, write it down.
Write it down. Yep.
And then we're going to come back at the end and revisit it like I forgot to last week. Although I think people got the answer from the discussion in there. But we're going to come back to it at the end, and we'll cover the answer. So here's today's question. We have stock trading for 100. There's 360 days until expiration. We have volatility set at 20%. This is in a pricing model, by the way. We have interest rates at 5%. And if you put those into a pricing model, it tells us that the 1-year $100 call is priced at 1033, and what's called the corresponding put. Everything is the same. We're just looking at the
right across the aisle.
Right across the aisle on your broker's platform is trading for 557 or is worth 557. These are what we would call the fair values. And what that means is that buyers and sellers are expected to just break even over the long run. Now, a little footnote here. These are European style. I think most of you know that there are two styles in the options market. We have two types, calls and puts. We have two styles. And so we have a European style and an American style. They've got nothing to do with the continents and everything else. It's just here in America, we have European style, we have American style. But an American style can be exercised early.
Anytime.
At any time. Not saying it's a good idea to, but you could. A European style, you can only exercise at expiration. Now, that does not mean you cannot close it. Whether you have an American style or a European style, you can always close it. I don't want my option anymore. I'm going to sell to close.
So when I do these little exercises, a lot of times we get this in Q&A a lot, Stu. People will say, why do you use European when the equity options that we trade, Apple's, Microsoft's, Google's, everything that you're used to trading, are American style? And that's a good question. And the answer is there is a very small additional value for the potential early exercise benefit. Doesn't come along often, but there is at certain moments in time, usually because of a dividend, where you can exercise a call or a put early. But if you do that, now we're accounting for multiple things. We're looking for the volatility value and we're looking at the exercise value. We want to block that out. So
and in the big picture, it doesn't amount to much.
It's going to amount to pennies. I just want things to add up perfectly. So sometimes I get people that ask about that and they say, hey, you're trying to pull something funny here by European style. No, it's just to make the math work out perfectly.
Yeah, let's just focus on what it is we're doing. It really doesn't have anything to do with European or American.
Okay, so now with that said, we have two prices. And the question for you today, how much are you paying for the volatility with the call? So I think most people know there's an intrinsic value, there's an extrinsic value. Most people say, well, it's the extrinsic value that is the volatility. That's a little hint. And that's what I want you to think about here for the next 30 seconds. We need some of that Jeopardy music, I think, Stu.
Absolutely.
We need you to just kind of think about it here. So just looking at the call for 1033, how much are you paying for the volatility of this option or the right to walk
John,
away?
Our engineer, can you infuse that into our
yeah, our future ones? We need a little Jeopardy music. All right, so here we go. So again, kind of jot down an answer. I want you to commit to it. So that's what we're going to talk about today, Stu. How much are you paying for volatility? And the reason this is important is that it really almost every single options decision. Should I sell this option? You might be doing a covered call and say, hey, look at this option. It's $30. Yeah, well, $29.75 of it is intrinsic value. It's worthless to sell as a covered call. And so if you don't understand which part of your option is volatility and which part is intrinsic, you're going to make bad decisions.
Worthless for what you're most likely trying to do.
Right. If you're just trying to create
if you're doing the covered call, most likely you're not really trying to protect your intrinsic value or the cash value down to the strike. I mean, that's generally not what people really do. They like to sell the at the monies or the out of the monies, and they like to call it, and I can't stand this term, but I'll use it, income generation. They're just kind of looking to create an additional cash flow from the sale of that option.
Right.
Anyway,
so that's a good example of where it can come into play. And if you're not aware of how much is volatility value, you're going to be making bad decisions. We see it all the time. All right,
which may actually be an incorrect decision for what you're trying to do. And that's the point. You may, you just may be going down the wrong road.
That's right. So let's take a look at that. How much are you paying for volatility? We have a feeling this is going to catch people by surprise, which is
or the other side is how much are you getting paid?
Yeah, if you're selling it, right?
To take on the volatility.
Right, to take on the obligation. So let's go back here and take a look at our call. So here's our 100 call for 1033. Now, again, most people know that we can break a call options price or any options price into two component parts. There's an intrinsic value, and in this case, it's 0. And that's because the stock is also at 100. I didn't print it on this page here, but I said that on the first. The stock is 100. We have the 100 call. So there's no immediate benefit. If we had the 95 call, we know it's worth at least $5 of intrinsic. Or, I'm sorry, worth exactly $5 of intrinsic, but the option would have to be worth at least 5.
Other terms for that are moneyness, cash value, intrinsic value, how much is it in the money?
How much is it in the money? Right.
All the same numbers.
So here we've got no intrinsic value. And we look over here and we say, well, the extrinsic value or the time value is the full amount, is the 1033.
100% of the price of the option, extrinsic value.
So this is all going to bleed away. It is fully exposed to the time decay. It is your extrinsic value. Now, most people will say that is the volatility value. This is what we're paying for the right to walk away. This is the volatility value. But what most people don't know is that the extrinsic value can be broken down into two parts, just like we can do with an options premium.
Yeah, and you kind of are paying the 1033. It is out of pocket.
It is total.
Right? There's another side to it where there's incoming money.
Yep.
And those two offset to a degree. And that's what we're going to talk about today.
That's what we're going to talk about here. So let's take a look at this 1033. There is another piece that is called the cost of carry, which is the interest rate you're kind of keeping by not buying the stock. We'll look at that in a moment. And then there is the volatility. So this 1033 could also be broken down into two pieces, just like the original 1033 can be broken down into two pieces. So we can take the intrinsic value and the extrinsic value, we add them up, 0 plus 1033 equals the options total price.
Total price, right.
We could do the same thing down here. We could take the cost of carry and the volatility, and we're going to find out that that's also going to come up to 1033. But when you're making your decisions for options, not counting maybe using it for a hedge, but for the income generation, for lack of a better word there, Stu, or for the amount that you're paying for the right to walk away, this is the one you want to focus on. And what most people do is they focus on both of them. So we have to.
And the cost of carry can have a really big effect. And
Huge.
sometimes people get swayed by the word cost. To me, when you think about cost, it's like out of pocket. What's it going to cost me? But this is a little bit of a switch. It's kind of the other way around, and we're going to show you how that really works.
Exactly. So the thing that we're trying to figure out here is between these two pieces, we really want to ignore the cost of carry, because as we're going to find out, I'll give them a little hint here, it's really the money that you're earning implicitly by not buying the stock.
Yeah, think about that for a second, right? Instead of
paying it's not an out of money pocket expense.
Right. You don't have to buy the stock at 100, right? You're just not buying it. You're not spending the money. So what are you doing with it?
Letting it sit in the money market.
Right. You put it in a risk-free return. That's what these models are based on. They're based on implied risk-free rates of return in the future. So if you're not spending the $100, well, what are you doing with it? That basic tenet of finance dictates that you really need to be putting it into a risk-free instrument. And this is where we're going.
Yep. So let's do that. Let's say we want to buy shares of stock. Now we're going to get a little fancy here, Stu. Instead of saying, let's buy the stock, let's buy the option. Mm-hmm. But maybe we can pull a fast one on the market here. Maybe instead of buying that, I doubt it too, but we're going to try. We could maybe put the money that we're not spending for the stock into the strike, what we will pay in the future. So we're going to take that.
Maybe.
Well, let's assume that we do want to exercise it. We're going to exercise it. And so we're going to park that money off to the side. And in the meantime, we can earn some interest. And that way we can offset the cost of the call. That's pretty slick little trick there, right? Let's see if it works.
And
how about it sounds like.
Right. And think about it, people. How about if it was a week or a month or a year? Right. What these models do is they take the implied T-bill rate for that term of expiration, and they pull it from the marketplace and they impute it into the values to create a theoretical value of an option.
Yep. And then we're going to show, that's actually what we're going to show you here. So what we're going to do, here's our little plan. We're going to invest the strike price at the risk-free rate. So let's say that
you're actually borrowing the money from yourself. You're not using it.
Sort of, or we're lending it to the market. We're going to buy a $100 T-bill. Now, the thing with a T-bill is that they're going to be priced at a discount. So obviously we wouldn't want to pay 100 and wait for a year and get 100.
Why not?
Who wants to do that?
Not a good deal.
It's definitely not a good deal, but we will pay less.
Wait a minute. I don't want to lend money to the government for free.
Not for free. You don't.
Isn't that what an income tax refund is?
That's what everybody. Yeah, no, everybody thinks that's free money.
People think that's free money, right? Yeah.
Oh, yeah.
You mean that's really not free money?
Yeah, it's a free loan. So here we go. We've got 95.24 is the cost. Now, little side note: the way that we would figure this out, if interest rates are 5%, which is what we assumed in the model, we're going to take this $100 strike price, We're going to divide it by 1 plus the interest rate, or 1.05, and that's going to come up to 95.24.
And
what
that's
this
what,
means,
Bill? Is that what you'd pay for the $100 T-bill?
that is exactly what you would pay for the $100 T-bill that matures in a year. So now what that means is we're going to receive 100 in 1 year. So think about it. If we pay 95.24 and we receive 100, that the balance is 476 in interest. Now, a lot of people might not know this. The T-bills actually don't pay interest like the bonds, or at least a lot of bonds.
Right. The bills do not. You buy them at the discount. The bonds, which are more than 1 year, they pay the coupon rate.
Right. So this is, you can still think of it as an effective interest rate, right? Whether you call it an interest rate or not, doesn't really matter. You're paying 95.24, you're collecting 100. So that's 476 in interest.
Yeah.
So here's my little.
And for those of you that don't believe this, go open up yourself an account at treasurydirect.gov, connect it to a bank account, and go buy yourself a 1 year bill for $100.
Yeah,
and
you'll
see
that.
how much they charge you.
Yeah,
you'd
be very
be
exactly
shocked
right.
how this really works.
Yep. So now here's my little plan. If we're going to get 476 back, and I was looking at that $100 call for 1033, this is my idea of pulling a fast one on the market. We're kind of getting some cash back here.
Cash back,
So,
like a credit
we're getting
card.
476 back. So now if we subtract that out,
Stu, you're an
we're
idiot.
actually paying 557 for the call.
Mm-hmm.
What do you think about that?
Well, I think that I laid 1033, and I think I'm getting back 476.
So what is the effective amount that you're paying for the volatility?
557.
Okay. Yeah. So now take a look at this. If you remember, what was the price on the pricing model?
I think it was
exactly the same thing. See, that is the price of the put.
And see, it's not
The
an accident,
put-
right? This is
No,
how it
these
works.
try them for yourself. These will work out. That's why I made them for 1 year to kind of make the math easy, but they will work out to the penny. What you're paying for the volatility is the put. See, I could go buy the stock and pay 557 and think that I'm doing better by not spending 1033, but I'm going to implicitly spend 476, even though, like Stu said, it's not an explicit cost, but I'm pulling that 100 out of the account to buy the stock now, so it's no longer earning interest. It's an implicit cost, but you still need to account for it. So take a look at that. It's kind of interesting.
So even though you guys are all thinking about, risk evaluation, risk and reward, and trying to figure out what's going on and what could happen, think about, like Bill and I always say, think about the things that you can't see.
Yep.
Think about the things. What's that quote about that? What that guy said? A risk is everything you. How's that go? A risk is everything.
Risk is what's left over when you think you've thought of everything.
When you think you've thought of everything.
Love
right?
that.
So maybe this is something you didn't really think of, right?
It totally is. People buy that and don't realize that you are missing out on interest.
Right. So here's the opportunity cost potential, right? You see this call, $10. I'm not paying that. That's way too much money. I'm not paying 10% for it's $100 stock. I'm not doing that. No way. Right. But if you really did the work and you'd see that it was half that money.
Yeah, it's half that.
Maybe it's a different story.
That's
I don't know if
exactly
it would be, but it might be. But see, now you have better information.
That's what we're trying to show.
A more educated decision.
The cost of this call, if you look at this, you shouldn't look at that and say, man, it's costing me 1033. I mean, it is in total. That's what you're going to be debited. But implicitly, you've got $4.76 coming back to you because you didn't spend the $100 strike on the stock. So what you're really paying for the right to walk away is $557, and most traders are going to tell you it's $1033. And that's going to cause misperception. So let's look at some more examples. And before we do, by the way, for anybody who might be new to options, please be very careful of where you get your information from. There's so much bad stuff out, like there is for a lot of things on the internet. But please check us out, marketrebellion.com/get started. Lots of free videos, information, strategies, things like that to help you get started.
Bill,
So
does that mean if I read something on the internet and it says this is the way it is. It may actually not be the way it is.
Like the earth is flat. That's exactly right. It might not be. So let's take a look at 20% volatility. All right. We saw the call was 1033. The put was 557. If we subtract out 476, which was the amount of interest, what's the net? Is 557. And again, notice that is exactly the price of the put. This is what you're paying for the volatility, not 1033. All right. This interest over here, this 476, is again from the money, the implicit money you've got coming in by not buying the stock.
Let me comment just for a second, if I can, Bill, on the that term paying for the volatility. What does that really mean? Well, you have a stock, and XYZ stock can go up, and XYZ stock can go down. It can go up 5 and down 5 and up 10 and down 10 and up 20 and down 20, and who knows where it can go, right? I mean, you have no idea. So when you're paying for the volatility, what you are is you're paying for the opportunity to participate in the upside, but you're also paying for the limited
insurance.
For the insurance to not think about that, to not participate
in the downside.
On the downside,
yep.
To participate to a much smaller degree, given the idea that maybe the stock could implode, maybe the stock can go to, 20 or 10 or 50 or 80, wherever,
or zero, like Enron,
or zero like Enron, or like almost zero, like Upstart, or one of those other stupid stocks like Peloton or whatever they are. And, then you're actually happy to lose the $10.
Correct. It's an insurance policy.
Because it would have cost you 80 to self-insure. And that's that's the approach here. That's kind of the idea behind these options is how can you use it to your advantage? How can you use the options market to transfer risk away from you, or actually take on additional risk,
or actually accept it?
It goes both ways.
So let's try the same exercise here. Let's bump up the volatility and see if it works. Let's go to 30% vol. Now, if we throw these into a pricing model, it tells us that our call is worth 1409 and the put is 933. Now, the cost of carry is going to be the same because it's still 1 year and it's still the 100 strike, right? So that's always going to be the same. And then what happens? We subtract them out. That's 933. And look at that. Oh, look at that. It's exactly the same price as the put.
And
that's
Bill doesn't make
the volatility.
Bill doesn't make these slides to make it match. He pulls them from models, from actual.
Oh, yeah. No,
models.
Exactly right. Try them for yourself. And try them with the 30-day. The interest will just be a little bit more difficult to calculate, but they will all come out to the penny. These are not cherry picked. That's why I wanted to do some additional examples. So again, this part right here is really something you shouldn't be considering as the volatility or the insurance value. This is just the cost of carry. It's a completely separate animal, and you need to be aware of that. Let's try it with something crazy, Stu. Let's go, although not crazy as GameStop, but we could. Let's go up to 80% volatility. What did we hit during COVID? I think we hit 85, didn't we, on VIX?
Yeah, we did on the VIX.
Hit 85. So if we pop that into a pricing model, we get 32.58 on the call, 27.82 on the put. What do we know? 476 is cost of carry. What's the balance? 27.82, and look at that. Exactly the cost of the put. That's your volatility component. This over here is simply the interest, the cost of carry, and you shouldn't be accounting for this. So part of what we're trying to show you is that if you're ever trying to make decisions, you're looking at your broker's quote board. We'll do some examples here in a moment. Just look directly across the board at the put, because the call includes the cost of carry, whereas the put doesn't, right? The put is the right to sell, which means you've got cash coming in. But this, for the call, it's giving you a benefit by not spending the cash. And that's why we have to cover the cost of carry. There's actually an arbitrage in here if that's not accounted for, but that's kind of the thought process behind it. Now,
puts actually, everyone, puts are actually going to cost less money in a rising interest rate.
Yes, they will.
Environment. I mean, something's got to give here, right? If you're paying more to carry the stock, then all else being equal, the put is going to go down. And then what's step 14th of that, right? If the put goes down, the call has to go up. So calls are actually worth more money in rising interest rate environments, and the puts are worth less. And the opposite, of course, in a lower interest rate environment.
So here's another little challenge we can do for everybody. This is the pricing model that I used, but instead of doing volatility at 30%, which is what I think 20%, I think is what I did. For the first one. But this is where you would change your volatility numbers. We can do a little trick here. Let's make it, I don't think this model will let you do 0%. So you can get it close to zero.
You can go as low as 1. Yeah.
We can go to 1. So what you're basically saying is that this stock cannot move, or at least not move very far over the next year. So if you had a call option or a put option, how much would you pay for it if somebody said this stock is stuck in the cement at 100? You say, well, it's not worth anything. Well, we can see the put is worthless, which kind of coincides with our intuition. But what about the call? What do you think that call would be worth, Stu?
Well, I think if I didn't buy the stock, I'd have a bunch of cash laying around that I could invest it at 5%, and I could get $4.76.
There you go. And look at that. See, so these things are not made up. That is the minimum. Another little pricing principle out there. That's the absolute minimum that a call option can trade for, is the cost of carry. So it doesn't matter how you cut it. We have to back this out. This has nothing to do with the volatility, nothing to do with the insurance, the right to walk away. And yet it can absolutely cause huge distortions, as we're going to find out. So as always, if you forgot that link, marketrebellion.com/get started, find all kinds of good information to help you understand options and to make better decisions.
So suppose you saw that particular option in XYZ stock, and you saw that particular option was trading for some reason, 452.
Right.
Assuming there's no hanky panky going on, something's wrong with that price. You got to be a buyer. You got to be a buyer. You just have to be a buyer. Right?
It's just too good to be true.
Yep. And if it is too good to be true, it probably is. But
that's probably,
maybe there's something going on that we don't know about. But it's just too cheap. Is it too expensive? Is it too cheap? I hear that all the time. How do I know if this one's any good? We gauge it by implied volatility, but there's a component to the implied volatility, like Bill's talking about. There's that cost of carry, which you really, really should consider, especially longer pieces of time, because you're borrowing money for longer periods of time. So the money starts to add up. Think about car loans or house loans or any of that kind of stuff. And the more expensive the options are, the more money they are, the more principal is involved, the higher the interest costs.
Yep. So let's take a look at an example. Let's say we wanted to do a strategy, one we use quite often, called the stock replacement strategy. And what we're trying to do with this is to use a deep in the money call, usually with an 80 to 85 delta. For the example, I just bumped it up here to 93 to make a point. But what you're trying to do is to still radically reduce the cost to control 100 shares, but you're still effectively controlling the stock. It's not much of that you're giving up, other than you're just getting it for a much, much cheaper price. So let's say that the stock is trading for 400 and we're looking at the 280 call. All right. So we've got a year to go, 360 days, 30% volatility. That's a decent vol, 5% interest. And the model says this, let's just call it 137.
So these are the 280s and the stock's 400. So what do I know? What do I know? I know that it's $120 in the money.
$120 in the money.
So I know that there's cash of $120. Is that $137 an expensive option? Well, it kind of looks like it's an expensive option, but when you back out the cash value of 120, now you're left with 17. And now we're going to go to the next step, and we're going to back out the cost of carry.
That's the thing that people miss. They go, okay, I get that there's $120 of intrinsic, so that means I'm spending $17 for the option. And what did we just tell you is the little clue? What do we do here, Stu?
We got to look at the put.
Just look directly across the board. The difference between these, minus the intrinsic value, is the what? That's your insurance value. So if you ask a professional trader, if I asked Stu, if he said I went and bought this 280 call, and I said, well, how much did you pay for the right to walk away? He's going to tell me 385. He's not going to tell me he paid 137. He's not going to tell me he paid 120. I can figure that out. I know it's worth at least 120. I want to know what he paid, not only over and above cash or intrinsic, but also over and above cost of carry.
Because that's real money. I'm gonna actually take that money. Right? Yep. If I don't feel like doing something else with it, what I really should do is I should take it and I should earn 5% with it. And that's real money coming in. It's not made up funny money, monopoly money. It's real money. So
it's one of the first slides that we did. He could invest 280. Okay, this would be the strike, because that's eventually what he would have to pay if he wanted the shares. Right. So the point to see is that all you have to do is look directly across the board. All right, so let's try taking a look at this from a different perspective. This is 385 for the put. That's a little over a penny a day. And come up to like 1.07 cents per day for a year. And yet people look at
that commercial. Sounds like that commercial about buying life insurance. It's going to cost you 9 cents a day.
9 cents a day. But most traders will look at this and say, I'm paying 137. And that is way too much. And that is a huge distortion. You're going to miss opportunities. Or they might sell this call option and go, oh, look, I'm making $137 on 400. No, you're not. You're making 385. So again, you can see why people make mistakes. Now, let's take this into a P&L diagram. Let's look at the 280 call. And look at that, Stu. I love this. In black is the stock right there at 400. Now we can see the red line. This is the current curve going out 1 year for the 280 strike, starting to bend around 280. And we start heading west out here. We don't continue down dollar for dollar like we do in the stock.
And so Bill, why does that red line or the option, why does that P&L flatten out? Because
it's our insurance policy.
Because it goes to zero.
Yeah.
That's it. It's done. Once it goes to zero, it's finished. It's over. Bye-bye. It's over.
Right. It's heading here. I always say it's heading west on the thing to the total cost, which was about 137. Now you can see it looks like it's above. I'm sorry. If we went way out here, it would eventually flatten out to 137.
137. It's what you can lose. While the stock
can go all the way down to zero, starting from 400. Now I know it's unlikely, but that's not the point. We get this benefit in here, but look at the trade-off up here. Stu, can you really tell a big difference starting from from even about 375?
No, there isn't any. And that's the 93 delta that Bill pointed out.
Yeah, that's because we're paying
same thing.
About $4. What was it? 385?
385.
That's what you're trying to separate. There's a 385 difference. That black line for the stock sits $3.85 higher than this. And in percentage terms, that is such a small number, you can barely detect it.
Right. So you're paying 385 to get the benefit of that green shaded area on the left.
Of this green shaded area, and to pay 137 instead of 400.
Yeah. Sounds good to me. I'm in. Where do I sign up?
And that's why this is called the stock replacement strategy.
It is. I need a coach. Yeah. This is the deal, guys. This is how it works.
It is behaving like stock, or at least for right now, according to my delta, is 93% of stock. It will eventually become delta 1 over time, provided that the stock stays above 280. But what a great deal. And yet when I look at this and say it's a great deal, it's because I'm spending $3.85. But if you ask most people, they'd say, oh, I wouldn't want any part of it. It's a $137 option. Yeah. It's not. It's 120 of cash, which absolutely does not count. And then you've got that balance of cost of carry, which doesn't count.
And then when the stock takes how much is the stock? 400. When the stock 400. Takes a 50% haircut,
down to here,
to 200. They're saying, "Oh man, this with the stock guy on one side and the option guy on the other," and the stock guy is like, "Oh man, that really stinks. I lost 50%. That hurts." And the option guy is losing 100%, but he lost $137.
Right, he still lost a fraction.
And somehow the stock guy thinks I don't know how, but somehow the stock guy thinks he did better. Right. I mean, it's fucking crazy.
It is crazy. All right, so let's do an actual example. Let's do a little deeper dive. Let's bring up the TOS platform. See if I can swing this over. I don't know why it won't let me latch on. Just very odd. There it goes. Okay, so let's bring this up. Let's just do, how about if we do Apple? Everybody likes Apple.
Everybody loves Apple.
All right, so here, oh, look at that candle today, Stu. Second candle break of the 100. So here's the scenario, everybody. We want to buy Apple, trading for 174 bucks. Look at that, 0.00. You don't see that too often. No, 174 bucks. And instead of spending $174, what if we wanted to do stock replacement? How would we figure out how much we're paying for the volatility? Well, let's go over to trade. Stu, what expiration do we want to use here?
Let's stick with the
1 year.
Yeah, we can do that. That's fine.
All right, let's go out. We'll go out 400 days.
Yeah, it's about a year, a little bit more.
Okay, we'll go out here. Now, the basic rule is to find a delta, which is this column right here, somewhere around 80 to 85. We don't have time to get into the nuances here, but let's just pick this 84. It's a
kind of a sweet spot.
Kind of a sweet spot. It's a 130 strike. Now, Stu, people are going to panic and go, yikes, that's a $55 option. No, it is not. How much are we spending for extrinsic value? Well, then people look over here and they go, oh my gosh, I'm spending $10.93. I'm spending $11 of volatility value. No, you're not. Stu, how much are we spending?
Well, I'm going to look over at the put, and I see it's about 365. So while Bill's doing this, I'm going to just do a quick calculation just to kind of check the model here. I'm going to see what I come up.
Let's call it roughly 375, $4. That's what you're spending for the right to walk away. That's your volatility value.
130.
This 1089, now what Stu's calculating here should come up to be 1089 minus 375, roughly. Or we should look at probably the marks. I don't even know if I have the marks up here. Yeah, pull them off. But they should be the kind of the halfway points of the bids and the offers. But that will come up to our cost of carry. And you can see it's pretty healthy. All right, we got 1083 here. We got about $4. So it should be somewhere around 683. Should be pushing.
The cost. It is. It's within pennies. The cost. It's showing an extrinsic value of 1083. It's a cost of it's around 7. So it's right.
There you go. It's right in there.
It's right. It's right in the game.
And what's throwing it is the bid-ask spreads too. But there you go.
Spreads. There might be a little. Well, I'm not 100% sure which interest rate the model is using.
Exactly. We don't know here.
It might be something different, but. I used 5%. It might be 4%, 4.5%. But you can see that's it. That's the game.
So this is the trick. This is the thing we want you to learn from here when you're trying to do really any strategy, but especially stock replacement. You're trying to find out how much am I spending for the volatility, for the insurance policy or the right to walk away. Look across the board at the corresponding put.
Yeah.
The call is not going to tell you that because it includes this value plus the cost of carry. And the more expensive the stock, and you start going out to a $400 stock 2 years in time, that cost of carry is going to get big quick. I've often said, Stu, the most expensive options on the board, even though we never hear about this as a what do you call it? Like why is that not coming up?
What are you trying to do? Oh, the Berkshire? They don't have options. I
know. I thought that I didn't see the quote didn't change. But if you wanted to know which one would have the most expensive options,
there it is.
Right there. It's a $500,000 stock.
Yeah.
It doesn't matter what the volatility is. The volatility could be very, very low, but this is like trying to insure a Ferrari.
What is that?
536,000. Yeah.
536,000. Can you imagine buying a strike price of 500,000 and not spending 500 G's?
So here's a question.
Here's
a question for our group. What's the minimum that call would have to trade for? Let's assume it's 1 year out and interest rates are 5%. 10% would be how much? Slide the decimal point one place over. Would be what? $53,000.
53 G's.
Now cut that in half. talking about
Half of
$26,000.
that. Yep.
So the bare minimum for a 1-year option would be $26,000, and people would freak. It's just the interest. And yet, again, that causes so many misperceptions for traders. So we just wanted to make sure that you didn't fall into that trap. So with that, Stu, let's go ahead and jump over to our Chalk Talk. So here we go. So for everybody there watching, you're looking at these two options. How much are you paying for the volatility with the call? What's the answer? Just look at the corresponding put. It's that simple. You're paying $5.57 for the right to walk away. And if you're going, but wait a minute, this is all extrinsic value. Why is it not 1033? Because this also includes a cost of. And if you're going, but wait a minute, this is all extra. All right. So anyway, any final comments? I think that's probably a pretty good stopping point.
I don't really, I just real quick here, one of our main men, Rob, hey, I know you're out there watching, and Rob asked me if I would take a look at something that he wrote in as a question on the chat, and I'm looking for it, but I don't know, I can't really find it. Why don't you invest it in T-bills? Oh, is this you, Rob? Why wouldn't you take $100 and invest it in T-bills and expect to get 105 at the end of 1 year? You would.
Well, it depends. If you invested 100, but remember what the idea was, we wanted it to grow to 100 because that's the amount we would need to exercise. You wouldn't need to invest 100 to grow over that. The market's going to say, if you want to buy the call in order to buy the stock, you would pay the discounted value.
It will change it by a couple of pennies. So Rob, we sort of addressed this in the beginning. Remember, like the American and European, yeah, there is a difference. The European takes away the early exercise. In the big picture, in the big scheme of life, it's not going to make that much of a difference. There might be a couple pennies difference.
Yeah, 10.55 cents, 10.50. It's going to be so small. It's just I wanted the numbers to come out exact so people could see it. And in order to do that, you have to use European pricing. But it would have been, like Stu said, a hand, pennies. Nothing even talk about.
And if there's a decent dividend, it might have an effect on it as well.
Different story. Yep.
Different story. But so what we're trying to do is we're really just trying to how do you
cancel out all the stuff that we're not analyzing,
that we're not looking at. Just zone in on what it is that we are looking at.
Yep.
All right. And then later on, what you do is you go back and you just kind of put the rest of the stuff in. And you come up with a bigger picture.
Correct.
Of what you're
right. We can always make it more complicated by putting that stuff in, but this is the essence of understanding the volatility component is seen across and this is assuming there's no skews. It's another wrinkle, but just looking for rough purposes, looking directly across the board at the corresponding put. So I think with that, Stu, we got to kind of wrap up. I know John's got to hop on another one, but I want to thank all of you for being here and spending it with us on this rainy day here in South Florida. I think we finally stopped, but I want to wish all of you a great upcoming weekend. Hopefully we get these candles back up over these moving averages, but regardless, the options will help you to hedge all of that risk. And we hope to see you next Thursday.